Have you ever noticed how a single headline can suddenly change your entire financial mood? You wake up, open your phone, and see something like Central Bank raises interest rates. Within hours, the stock market drops, your mortgage estimate jumps, fuel, groceries, and rent quietly get more expensive. Your local cafe starts talking about slow business, and Wall Street analysts begin panicking on live TV. It feels like an economic earthquake. But here's the strange part. There was no war, no natural disaster, no sudden shortage of food or energy. The epicenter of this financial shock wasn't a battlefield or a factory, it was a conference room. Behind closed doors, a small group of officials made a decision, and that decision instantly reshaped the financial lives of billions of people. These officials are not presidents. They are not prime ministers. You never voted for them. They are central bankers, and whether you realize it or not, they may have more control over your money, your job prospects, and your future than any elected leader you see on the news. In this video, we're pulling back the curtain. We're going to explain what a central bank actually is, why it has so much power, how its decisions directly affect your wallet, what happens when central banks get it wrong, and who truly owns and controls these mysterious institutions. Quick disclaimer. This video is for educational purposes only and is designed to explain economic concepts in a simple, practical way. Now, let's meet the real boss of money. Section 1. What exactly is a central bank? At its core, a central bank is the highest authority in a country's financial system. You can think of it as the bank for banks, the traffic controller of money, or simply the big boss of the economy. Unlike your regular bank, a central bank doesn't serve everyday customers. You can't walk into the Federal Reserve, the European Central Bank, or the Bank of England and ask for a debit card, a personal loan, or help opening a savings account. That's not their job. Instead, central banks operate behind the scenes, quietly controlling the foundation that all other banks depend on. Your local bank, whether it's HSBC, JP Morgan Chase, Bank of America, or any other, exists under the rules and systems set by the central bank. Almost every country in the world has one: the Federal Reserve in the United States, the European Central Bank for the Eurozone, the Bank of England in the UK, the Reserve Bank of India, the People's Bank of China. Different names, different structures, but the same core power. They hold a legal monopoly over money creation. They are the only institutions allowed to create a country's official currency, whether that money exists as physical cash or digital numbers inside computers, and that single privilege gives them extraordinary influence. Section 2. The 3 most powerful tools central banks use. Most central banks operate under a mandate that sounds simple but is incredibly difficult in practice. Keep inflation under control, support employment and economic stability. To do this, they use 3 major tools, 3 levers that can speed the economy up or slam the brakes on it. Tool number 1. Interest rates, the gas pedal and the brake. Interest rates are the price of money. When a central bank sets its base interest rate, it is effectively deciding how expensive or cheap money will be throughout the entire economy. Think of interest rates like driving a car. When the economy is slowing down, people aren't spending, businesses aren't hiring, the central bank presses the gas pedal. They lower interest rates. Suddenly, mortgages become cheaper, business loans are easier to get, credit cards feel less painful, consumers start spending again. This extra spending helps businesses grow, hire workers, and restart economic momentum. But if the economy speeds up too much, another problem appears: inflation. Prices start rising faster than wages. Your money buys less every month. To stop this, the central bank hits the brake. They raise interest rates. Borrowing becomes expensive, people delay buying homes and cars, businesses pause expansion. This slows the economy and puts pressure on companies to stop raising prices. But here's the danger. Brake too hard and you cause a recession. This is why central banking is often described as trying to land a plane in thick fog with millions of lives on board. Tool number 2, digital money creation, open market operations. Most people imagine money as paper bills. In reality, over 90% of money today is digital. Central banks manage this digital money supply using something called open market operations. When the economy needs help, the central bank performs an expansionary operation. They literally create new digital money and use it to buy government bonds from commercial banks. No trucks, no printing presses, just numbers typed into a system. This injects cash into banks, increasing their reserves. Banks don't lend this money directly to you, but having more reserves makes them feel safer and more confident. They compete harder for borrowers, lower loan interest rates, increase credit availability. Money flows into the real economy. When inflation becomes a threat, the central bank does the opposite. They sell bonds back to the banks. The banks pay for those bonds using their cash reserves. This pulls money out of the system, reduces lending, and slows inflation. In extreme situations, central banks use a more aggressive weapon, quantitative easing, or QE. QE involves buying massive amounts of long-term government bonds and sometimes private assets to force long-term interest rates lower. Supporters say QE prevents economic collapse. Critics argue it inflates stock markets and real estate, making the wealthy richer while everyday people struggle with rising living costs. Tool number 3, the watchdog and lender of last resort. Central banks are also regulators. They set rules on how much cash banks must keep on hand, how risky banks are allowed to be. This helps protect depositors, people like you. But their most critical role appears during panic. If too many people rush to withdraw their money at once, even a healthy bank can collapse. This is called a bank run. When this happens, the central bank steps in as the lender of last resort. They provide emergency funding to stop the panic. We saw this clearly during the 2023 Silicon Valley Bank crisis, when authorities stepped in to prevent a chain reaction that could have spread across the financial system. Without central banks acting as backstops, modern banking simply wouldn't survive. Section 4. Why markets react to every word central bankers say. Have you ever watched a central bank press conference? Every word is dissected, every pause analyzed, every phrase compared to previous speeches. That's because financial markets don't react to the present, they react to the future. Investors, banks, and businesses are constantly trying to predict what central banks will do next. A perfect example is the transitory inflation mistake of 2021. For months, central bankers described rising prices as temporary. Markets stayed calm, borrowing continued, asset prices surged. Then the language changed. When officials admitted inflation was not temporary, markets panicked. Interest rates spiked, stock markets fell, mortgage costs jumped almost overnight. This psychological shift affects everyday people too. Mortgage lenders raise rates before official decisions. Credit card APRs adjust in anticipation. And when the U.S. Federal Reserve raises rates, the U.S. dollar often strengthens, hurting exporters and putting pressure on developing countries with dollar-based debt. One sentence from a central banker can move trillions of dollars. Section 4. When central banks get it wrong. Central bankers are highly educated, but they are not infallible. History shows what happens when policies backfire. The 2008 financial crisis. After the early 2000s tech crash, interest rates were kept very low. Cheap money flooded the system. Banks gave out risky mortgages. Housing prices exploded. When rates finally rose, millions of borrowers couldn't afford their payments. The bubble burst.
Lehman Brothers collapsed, and the global economy entered the worst recession since the Great Depression. Japan's lost decades. Japan offers another warning. After a massive asset bubble burst in the early 1990s, the central bank pushed interest rates to zero and even below zero. They printed money, they bought bonds, they tried everything. But people didn't spend. Traumatized households chose to save instead. Decades later, Japan still struggles with low growth, massive debt, and a central bank that owns a huge share of the government bond market. Money alone cannot fix psychology. Section 5. Who actually owns central banks? This is one of the most misunderstood topics in economics. Most central banks are officially independent. They are designed to operate without political pressure, so governments can't print money just to win elections.